Yo guys, welcome to the new video. In this video, I'm going to show you how the market moves from the liquidity point to the liquidity point and how we should trade the market from using the liquidity perspective, right? So, the market moves from the structural forward, right? That's it. How the smart money people will trade. The smart money people will trade like this. They will take order blocks from the premium and they will trade. They will sell. They will take order blocks from the premium and they will sell. Yeah, we can trade this way, but this is not a high probable way of trading because many of the times the market maker provides traps like this. So we trade from where the market maker is trapping the people, where the majority of the people are trapping and providing the liquidity for the market makers. Then we are entering into the markets. This is how we trade from the liquidity point to the liquidity point. Now I will clearly explain the strategy how we can trade the liquidity point to the liquidity point, and then I will show you some examples of the strategy. Yeah, I will confirm you, if you can master this simple strategy, you will be enough to be profitable in the markets. It's sure, it's for sure. If you can master this single strategy, you will be profitable enough. See, we are doing completely opposite to the smart money guys. We are doing completely opposite to the smart money guys, right? What is this liquidity? And what is this liquidity? Is there any difference between these liquidities? This liquidity is called buy side liquidity, and the liquidity here is called sell side liquidity. So according to the algo trading strategy, after the buy side liquidity is taken, we should look for sells, and after the sell side liquidity is taken, we should look for buy. Simple as it is. We should do vice versa. If the buy side liquidity is taken, we should look for sells, and the sell side liquidity is taken, we should look for buys. Simple strategy. See, after this was taken, the sells came, and after this sell side liquidity is taken, there's a good buy, and again, let's follow the trend. We should just follow the liquidity and the money. We should just follow where the money is. The money is here, the money is taken, then drop. Same thing. This is where the another sell side liquidity is there. See the sell side liquidity. Can you see the push? And again, there's the buy side liquidity. This is the buy side liquidity, right? Buy side liquidity taken, push, and again sell side liquidity taken. Can you see the nice push? How many pips? 148 pips. Again, sell side liquidity from here taken. Can you see the nice push? Again, buy side liquidity taken. Here can you see the push? Again, sell side liquidity taken. Can you see the nice push? How many pips it gave? It gave 250 pips. Again, the same thing happens over and over and again in the market. Same thing repeats itself. After the buy side liquidity is taken, the market's out of. After the liquidity is taken, the market gave a nice reaction, good reaction, right? And there is a huge drop off because of this economic events. There is a huge events. Is there? Huge high volume impact news. That's why these three executive candles. Same thing happens over and over and over and again in the market. See, buy side liquidity taken. Can you see the huge push? And again, buy side liquidity taken. Can you see the drop? Again, the sell side liquidity is taken. Can you see the push? And again, the sell side liquidity is taken. Where is the sell side liquidity? Here, right? Sell side liquidity is taken. The push, can you see the push here? Let me show you. Yeah, can you see this 3 days push of the sell side liquidity is taken, and again it was taken. Push until where? Until the buy side liquidity. Here is the buy side liquidity. The buy side liquidity is taken. The market again short enough. Sell side liquidity. and where the market turned bullish. This is how we combine both the structure and smart money in order to understand the direction of the market. In order to understand the direction of the market, the structure is nothing but where the market is moving. If the market is moving up or the market is moving down, there is no rule for the structure to just follow this pattern. In the real time markets, the structure will be like this. It will do like this and it will go, it will do whatever we want and go up. So the key is liquidity here. The key is not structure. The structure is just to identify a trend, whether it's bullish or bearish. And the main entry model comes with the liquidity. The liquidity is main driver. The structure is just used to identify the direction of the market, where the market is heading. So in this scenario, the structure is bullish. We don't get entries and trust the OBs because of the structure. We get the entry models and entry criteria using the liquidity. Here, this is the way we combine both the liquidity and the smart money. Right? Same thing here. Here the structure turned bullish, gave a nice reaction, bullish. There the liquidity point. Ask yourself, this is one liquidity point, gave a nice reaction. This is one liquidity point, gave a nice reaction. This is one liquidity point, gave a nice reaction. This is one liquidity point, gave a nice reaction. This is also a liquidity point. Can you see after the liquidity is taken out how much impulsive moves are coming? If you can grab these moves and target these are insane swings. Very high probability to see. After this liquidity is taken out, can you see this drop? And after again, yeah, I will talk about the liquidity phases on the next video. How the market makers will induce the liquidity using the liquidity injections. This is the concept I learned from the mentor called Ben Cisner. I will teach you. This is how the liquidity will be enlarged in the market. First, the liquidity will be small, and the liquidity will be enlarged like this, and the liquidity will be. There will be phases in the liquidity. The liquidity will be enlarged like this in the market. The liquidity never will be like this. It will be enlarged, enlarged, enlarged. This is how the market hunts the moves. Again. So after this liquidity is taken out, what we should target? We should target this equal highs liquidity, right? This is how we trade the market from liquidity point to liquidity point. Easy trading, no stress at all. And apart from the liquidity, there will be another concept is there. This is called ICT's AMD cycle, means accumulation, manipulation to the one side, and then the real move distribution. What's the real context of liquidity behind this pattern? This is also called the retail pattern deception, means what the retailers think when there is a retail pattern. See, this is a wedge pattern, right? What the retailers thinks when the wedge pattern arrives, they will think that if the market give breakout in one direction, the market will rest continue in the direction. But what happens is it won't do like that in the market, because if the market gave a break of the structure and it continue like that, everybody in the market will make money. So the market maker don't like that. So what they will do is they will create a fake breakout and they will induce the retailers to put the money and investment in the markets, and they will hit their stop loss and go in the real direction. This is what called ICT's AMD cycle. Accumulation will be happened. There is ton of lakhs of liquidity will be provided at the highs and lows of the retail trend line, or vice versa wedge pattern something. They will give a huge bullish or bearish volume candles in the breakout, and they will slowly turn around and move in the real direction. And if there is any liquidity point in the above, they will reach that and they will continue to downfall. This is how the liquidity aids in the movement of the prices, not smart money. We should not see the smart money as break of the structure, and if you trade, our account will be hurt. So if you are trading this liquidity concept, it is very high probable to trade, and we should also take very less trades in the market. Less is more always in the market. The trading is 90% psychology and 10% only technicals. We can use any strategy to make money in the market. So the thing is we should be like a sniper, not a machine gunner. We should only take the trades that are 90% or 80% probable to us, and not take the rest of us. It's 99% waiting, 99% waiting, not at least 90%. So sit hands on. Trading is not about having kick in the markets. Many profitable traders come to the market to take profits. Many gamblers come to the market to have kick in the market. So that's why they never win in the markets consistently. Right? Have a good day. On the next video, I will show you how the liquidity injection moves and how the market makers will increase the liquidity by using the liquidity phases, phase 1, phase 2, phase 3. Yeah guys, have a good day. Peace.